Hey everybody, Marty Mazzora here. It is after hours on the 18th of January, 2024, Thursday. Clients, this will be in your email inbox, linked, and will serve as Friday's message. Once again, nothing new to report to you. For the most part, folks, this is just a concerning setup. Certainly when we get into the longer term setups, the daily chart, the weekly charts, and the monthly charts, we have some concerning divergences that just tend to, more often than not, result in something that ends up being painful for short-term minded investors, let's say. For our purposes, it is helpful on top of all the fundamental work that we do to determine whether or not the risk-reward setup allows us to add more volatility to the portfolio, perhaps with equities, although we are multi-asset class investors. But people are most interested in equities. It's what the news talks about. So it's what we'll talk about here. But as you know, at times we get into commodities. Certainly on the economic updates is where we'll drill into other asset classes and consider their economic implications. And so for this evening, we'll just focus again on the daily charts. I'll take a look at the S&P, the NASDAQ 100. We'll touch on small caps. And then I do want to just kind of offer up some more fundamental, say, economic data that I would typically cover on the economic update in the next day or two. So I'll try not to be redundant when I follow back up here shortly with that. I do want to touch on breadth indicators, and then I just kind of randomly picked a few of the indicators that are components in our macro index to just kind of give you a feel for why we continue to sound a defensive tone herein, and why, for example, we brought our hedges up a little closer to the money today and we're able to roll them out a little further than we normally do, so we can just sit on that protection at a time when the things can get somewhat precarious. So meaning closer to the money means we have reduced our downside potential here relatively cheaply, we think, based on the cost of volatility right now. And so it felt good to do it. So anyway, for this evening, I do want to touch on yields and the dollar. I don't know if I said that earlier. Remember last time, just a couple days ago, we were looking at this pattern right here. And I said that if you are a bull, or you want to be a bull in stocks, you don't want this, the 10-year Treasury yield, to turn into a bull flag pattern. And you can see the last couple of days are kind of confirming that that's exactly what you have. And while today ended up being an up day, an upgrade of Apple, I think, had maybe a not small part in getting that off to the races a little bit. But again, rising yields, the way stocks are trading, are going to be a headwind right here. We do think that ultimately this probably rolls over very hard if our recession warning signal comes to ultimate fruition, which we think there's still not small odds that in 2024, I do think it's going to be in the course of this year, either this is going to play out, or the indicators that are telling us it's likely are going to abate, and we'll have a different conversation. So again, in that, recessionary conditions would be something that would bring yields down notably. And then the dollar, you recall that we were looking at this consolidation pattern. We were just breaking out this. I did the other video during the day. We were just breaking out with this candle. You can see that came up, and the dollar has been finding support at its 50-day exponential moving average. If that continues to pop higher, that's problematic for equities as well. As for equities, S&P 500 index daily chart, this is just simply and unequivocally a poor looking technical setup. These don't always play out the way they're set up, but folks who've been with me for the last, however many months and years, how often they do, right? And typically, this was fairly classic bear flag that played out right on cue. And then here is where we got very bullish on a short-term basis because we had very bullish divergences here, and that played out. But folks, we just have the opposite here. We have right now what looks more like this before we corrected here. And if we go back to the all-time high, looks a lot like right before we rolled over pretty hard in 2022. None of this means that's how it's going to play out. It just means that the risk is elevated right here. Very much so on the NASDAQ as well. You can see we're right at the highs from December, and we are not even remotely confirming that with the momentum here. So this says at odds favor that this is going to fail. We could go marginally higher, and we'd have a rising wedge. It's going to take a lot to burn through these divergences, though, unfortunately. And then on the Russell 2000, I told you that the volatility indication for the Russell was significantly higher than the S&P and the NASDAQ 100, and therefore the potential for something more significant to the downside, which is what we've seen. And I had this bear flag painted right here, and you can see that that would give us a target somewhere down here in the high 1800s. I do have a line right here at 1905, and as you can see all the action that really bumped up against that line. Most of it was resistance. The index poked its head and closed just above that here. You don't want to see that break down because you've got some potential pretty significant downside here. But for this bear flag to play out, you're going to lose the 50-day in a hurry, and you're going to be testing that 200-day moving average. And we will get bounces off of here. We think that ultimately in a recession scenario, we probably plumbed new lows for the bear market. Either it's going to play out, or we're going to have a different song to sing with regard to what the indicators are suggesting for us. And then in the written blog, and I think I touched on it in the video, our breadth indicator here has been interesting, and I found it actually to be very valuable as a shorter term indicator as well. You can see right in here, for example, when we got bullish, we had a bullish divergence on the number of members of the S&P 500 that were trading above their 50-day moving average. So the market was continuing to fall, but this was turning up. Now this is a very high number, but when you go back here, you have a nice uptrend here, but you essentially got a lower high and then rolling over really hard, but we're still up there in this wedge. So when you go back, and again, here was another bullish sign, but leading into that was a long bearish divergence before we had, a really significant downturn. You can see right in here before, the COVID situation hit, big precipitous drop, but we had this long divergence developing. We had, in here, we had this as we corrected late in the year, but we got a bullish look and came out of it pretty strongly. So you can go and find shorter term indications, good or bad. And they're not all going to be confirmed, but here nothing big, but then you had some weakness in the market. So anyway, so that's giving us an indication that odds favor breaking down below that wedge, just like in the regular price chart momentum indicators that I showed you. 200-day moving average, same kind of look here, right? Just a flat line there, which would be bearish because we have a rising trend right here, rolling over pretty good there. It's still a good number. It's nice to have 70% of the members above their 200-day moving average, but that's not what we're talking about. We're talking about the level and where that number typically is in a good solid uptrend, and it's usually gets better or holds higher levels as we continue to move into new highs. And again, slower moving because there's it's a 200-day moving average, but you can see right there, you can see right here, you can see the bottom pattern right in there as well. And now just jumping to more economic stuff, CAS, the CAS freight data is a component in our PWA index, and as you can see, it's continuing to roll over. So that's a recessionary look. I don't care how you slice it. It doesn't mean we always have to have recessions when things roll over like this. It's very, very noisy. This, though, is a concerning trend in shipments, and then in expenditures, very, very bearish look coming off of record high levels. Of course, things got very expensive, shipping and everything else, and now rolling over like this suggests that less demand for shipping, therefore expenditures are coming down. And you can see what that looks like. And these big red areas are recessions. And lots and lots of the stuff that we track are giving us signals. Some of them have really no false signals. And this may be a first. I'm actually open to that idea. But if we don't have a recession, I think if we don't have it this year, there's going to be quite a number of first-time evers where we have indicators that say one thing and they didn't ultimately lead to recession. So retail sales just came out. Actually did a number on the market when it came out yesterday because it was better than expected, but you can still see the trajectory. Certainly nothing that's giving us new highs, but we had this anomaly because of all the money that was given away during COVID. And you can see right here before the COVID recession, we had a spike. Right here before the great financial crisis, we actually had a spike up as well. A little one here as well. So it's not unusual to get a thrust right before recession ultimately hits. Redbook is more high frequency. This is a weekly look, and it looks like it may be rolling back over. So we'll see. It's going to be an interesting few weeks and months to come. Institute for Supply Management, very important components in our index. The yellow is services, the white is manufacturing. We have been mired in a recession in manufacturing for well over a year now. You can see it's getting a little better, but below 50 still means we're in recession, essentially. The Empire State Manufacturing Index was utterly abysmal. It came out earlier this week. And as I've shown you before, it's usually manufacturing first and then services follow. And as you can see, it's unusual that you get services, down to this level without ultimately rolling over into recession. And again, I think if it's going to happen, I think it's months from now, certainly not years. Throwing random things out here at you, but they all kind of give the same signal. Job openings, job openings are, of course, leading indicators. And they got huge, right, after COVID just kind of distorted everything. But you can see the trajectory now. That's basically saying weakness is going to start showing up in those headline numbers, the BLS report, weekly jobless claims, and so on. The quits rate is high when the economy is good. It rolls over when the economy is not, meaning people do not quit their jobs when they don't have other ones in the offing. And, you can talk about levels all day long, but you really want to talk about the change and the rate of change, right? You can say, well, these are still really high levels, but this is a plummeting, down 15% rate of change year over year for jobless claims. So these are just things that are out there. Now, it's not all bad, right? I mentioned the Empire State Manufacturing Index. It looks horrible, but then expectations are beginning to look a little better. And in fact, now that I'm saying that, let me just show you that, and then I'll be done. So here is the Empire State Manufacturing Index. Surveys said it would be down 5, down 43.7. Incredible. Haven't seen anything remotely like that since COVID, right? And then the new orders, really bad. Now this is just one region though, but you don't get here without pretty much being in recession, and we're not in recession yet. That just shows you how bad manufacturing is. However, expected new orders, right, are picked up. So for whatever reason, even though new orders were a disaster, they're getting a sense in the New York region that things are about to pick up, right? So expected employee work week, right? So we have to take that into account. This says one thing, and I'm sure we've never had these levels without being in recession, but this says that, we have to stay open-minded. Now, there's not a lot of those indications out there. There's more that tell you we should be concerned in those leading indicators, but we need to be objective. We don't have a desire to be right on a recession call or what have you. Our only objective is to, as accurately as we possibly can, have our finger on the pulse of the overall risk-reward setup. And what I keep telling clients over and over again, we don't want to hike at a high elevation because we have a 50% chance that a blizzard's going to hit the mountain while we're up there, and that could be very devastating. So we want to stay hedged and diversified, and we will definitely have our drawdowns on a daily and weekly and even monthly basis, but we just don't want to be in a position to get some sort of a crippling result to a surprise, or just the data deteriorating and finally the reality of a recession hits and earnings drop and stocks go down, an average of 37.5% or something. So all we're saying is that the risk of something like that happening is heightened right here. But we're forever looking for evidence that that risk is abating, right? And if it abates and we don't have that big sell-off, then ultimately the coast will clear and we can start climbing that mountain or adding some risk, perhaps, for lack of a better term. But you don't do it here when you look at the abundance of data that I'm showing you. But we do consider things like we're seeing here as well. This is not nearly convincing enough to tell us that the bottom's in and blue skies ahead. No, but we're looking for every little bit of evidence that things are beginning to look up. Now, problem right here is, though, that if we don't have a shakeout and things actually are bottoming and getting better, well, then the Fed probably doesn't get to their target in any kind of durable way. And therefore, the notion of 5 or 6 rate cuts goes away. And inflation doesn't go away. And the Fed starts talking hawkish. And that creates a lot of volatility. That severely limits the upside for the market as well. So they're kind of darned if they do, darned if they don't in terms of the Fed and what they're ultimately up against. It's just tough for them to let markets and the economy play out, do the work that needs to be done. Recessions aren't all bad because of the clearing effect, and then that's where the bad guys are caught, and that's where the froth gets eliminated. And if they keep doing things to circumvent or kick the can down the road, it just tends to make things worse when finally business nature just takes its course. And it seems like the more they prop it up, and the more the data gets distorted and the government kind of inspires certain investment in certain areas, the more the bubbles form, yada, yada. So anyway, just got to stay on our toes and be aware of the risks out there. Folks, thank you as always for watching and listening. I'll be back in a day or 3 with your economic update. Take care. Bye-bye.